If you do not understand bonds, you do not understand money. That sounds strange to many people because bonds are boring, and boring things never get invited to the front of the financial stage. People would rather talk about artificial intelligence, political drama, China, cryptocurrency, or whichever stock doubled last quarter. Bonds do not flatter the ego that way. They sit quietly in the background, paying a fixed return, looking like furniture. But furniture can matter more than fireworks. The bond market is one of the great pieces of financial furniture in the world. It holds up everything else, and if you do not understand what that means, you will keep looking at your business, your mortgage, your investment portfolio, your cash flow, and even your own ambition through the wrong lens. Most people think wealth is created by effort alone. I do not. Effort matters, intelligence matters, timing matters, temperament matters, but above all else, capital has a price, and that price changes the logic of nearly every decision in the economy. A person can work harder than ever and still feel as though the world has become more difficult around him because money itself has become more expensive. Another person can be mediocre and still look brilliant for years because the environment around him makes money cheap and mistakes easy to finance. That is what bonds tell you. They tell you the price of money. And once you understand the price of money, you start seeing the whole economy differently. A bond is simply a loan. You lend money to a government or a company. In return, they pay you interest and eventually return the principal. That sounds too simple to deserve the attention I am giving it. But simplicity is often what people dismiss right before it shapes their entire life. If the United States government will pay you 5% with essentially no credit risk, then that 5% becomes more than a yield. It becomes the hurdle rate for everything else. That idea runs all through the source document you gave me, and it is the right place to begin. Fayfalecite Fayturn 82 File 0 Fay, it becomes the thing every other investment must beat. It becomes the gravity acting on stocks, private businesses, real estate, lending, and even the ordinary behavior of consumers. If you can make 5% doing almost nothing with almost no drama, then risk starts requiring a much better explanation. Why buy a weak business? Why lend to a shaky borrower? Why fund an expansion with uncertain economics? Why chase a speculative story? Why pay a premium multiple for a company whose future is still mostly a promise? That is the bond lens. Most people do not use it. That is why most people misread the environment. They think the economy is confusing because they are staring at outcomes instead of price. Let me put it to you the way I understand it. Bonds are like gravity for money. When the yield is low, money floats, it searches, it chases, it speculates. It goes looking for excitement because safety pays too little to satisfy anyone. People spend more easily, businesses borrow more easily, investors get paid less for caution and more for boldness. The whole system becomes looser, warmer, more forgiving. Mistakes take longer to punish. When the yield is high, money drops. It becomes more selective. It becomes harder to raise. It demands a better reason before it moves. Consumers delay, businesses feel it. Asset prices have to justify themselves more. Honestly, weak projects die faster, strong ones live, but even they must fight harder for oxygen. That one boring number changes the whole mood of capitalism. I have known business owners who thought their problem was marketing when their real problem was the price of capital. I have known investors who thought their problem was stock selection when their real problem was that they were competing against a risk-free return they had not even bothered to measure. I have known households who thought the world was becoming hostile to them personally, when in fact the whole system had simply moved from rewarding spending to rewarding saving. That is why I say if you do not understand bonds, you do not understand money. Now let me take it out of theory. Suppose you run a business that sells something people need only if borrowing remains easy. Maybe you sell a kitchen remodel. Maybe you sell premium windows. Maybe you sell large HVAC replacements. Maybe you sell a high-ticket cosmetic service that consumers justify when their monthly payment does not scare them too much. When rates rise, the customers do not merely become moodier. Their arithmetic changes, the payment changes, and when the payment changes, demand changes. That is the part many business owners miss. They think they are competing against the company down the street. Sometimes they are, Very often they are really competing against the cost of money. If the customer used to finance a $10,000 purchase at easy terms, and now that financing costs meaningfully more, then your value proposition has to survive a different world. Your competitor is no longer just another seller. Your competitor is the rising cost of capital itself. The source text makes this point through wants versus needs and through the HVAC example. And I think that instinct is correct. Fay file a site, Fay turn 82, file 0 Fay. That is why the answer in a high-rate world often changes. You stop leaning on what feels nice and start leaning on what protects value. When bonds are high and money gets tight, the winning offer often stops being the shiny new thing and becomes the value-preserving thing. You help the customer protect what he already owns. You help him prevent a larger future expense. You reduce the need for financing rather than leaning on it. You sell the $50 fix more effectively than the $10,000 dream. That is a very different style of business thinking. And it becomes obvious only once you understand what bond yields are telling you. This is why the bond lens is not just an investor's tool, it is a business tool. Years ago, I looked at the possibility of buying a small industrial business that was struggling. I understood the industry, I understood how to improve operations, I understood why the business had gone stale and how a disciplined owner might make it work better. The business itself did not frighten me. The number did. When I ran the expected return against the prevailing risk-free rate, the question became unavoidable. If I can get 5% with no headache, no payroll, no damaged equipment, no customer concentration, no supply chain issues, no cultural cleanup, no debt negotiation, no time spent, and no reputation risk, then is 10% in this acquisition really attractive? That sounds like a ridiculous question to people who never use the bond lens. They hear 10% and their eyes widen. 10% sounds wonderful until you compare it with what else your capital could do at almost no risk. That comparison is the whole point of the document you gave me. And it is a sound point, faithful as site Fay turn 82 file 0 Fay then. The 10% stops sounding like a return and starts sounding like a spread. And that spread may be too thin. This is one of the biggest ways bonds make people rich. Not by paying them enormous amounts directly, by protecting them from distractions, by telling them when a deal is not good enough. A business owner who never compares his expected return to the risk-free rate is not thinking like an allocator. He is thinking like a romantic. Romance has cost people a fortune. A lot of entrepreneurs fall in love with deals, industries, distress situations, turnaround stories, or even their own ability to fix things. They forget to ask the essential question, is the spread over risk-free money actually worth the risk, the effort, the time, the distraction, and the opportunity cost? That last phrase matters a great deal, opportunity cost. People use it casually. It literally every dollar has alternative uses. Every hour has alternative uses. Every ounce of attention has alternative uses. If I take a business that will make 10% with significant effort, while risk-free money pays 5%, then I am not choosing 10% over nothing. I am choosing an extra 5% over safety while absorbing all the operational burden that may be worth it. It may also be a very poor bargain. This is why people who understand bonds often look more disciplined than people who only understand profits. Profit is overrated when it is disconnected from capital intensity. A company can say, I made $300,000 this year and still be in a terrible financial position. Why? Because what matters is not just profit. What matters is how much capital had to be tied up, consumed, reinvested, or borrowed to produce it. Let me give you a simple example. Suppose I put $500,000 into marketing and inventory, sell $1 million worth of product, and after all expenses I show a $300,000 profit. That sounds lovely. Until I discover I need another $500,000 of inventory and working capital just to do it again at a higher level next year. Suddenly the profit is not a pile of free money. It is a partial refill of a machine that consumes cash as it grows. This is one of the reasons I have never been seduced by accounting profits alone. Growth can be a cash trap. The faster some businesses grow, the more cash they consume. They must finance inventory, receivables, equipment, people, facilities, and distribution before they can harvest the result. On paper, profits look healthy. In reality, the owner may be starving for liquidity. The source material is very strong on this distinction between accounting profit and actual compounding cash, and that distinction is exactly right. Fay Falecite, Fay Turn 82, File 3 Fay. That is a dangerous place to live. The bond lens clarifies that too. If your business is consuming capital to grow, then the return on that capital must be judged against the risk-free rate. If it barely clears the hurdle or only clears it under optimistic assumptions, then your growth may not be worth what it costs you in risk and effort. A lot of millionaires understand this, very late real millionaires. Think about how their cash compounds. Not just whether the income statement flatters them this quarter. Compounding cash is what matters. That is how $300,000 turns into far more than $300,000 over time. That is how small industrial businesses become very large enterprises. That is how an owner gets rich instead of merely busy. This is also where the public often misunderstands competition. They think a business is competing with the other business on the same street. Sometimes that is true. But if you ever need outside capital, if you ever need banks, lenders, bondholders, investors, or even just retained earnings to work productively, your biggest competitor is often not another entrepreneur. It is the U.S. government. That sounds strange until you think clearly. If a lender can earn a respectable return in government bonds with almost no risk, then why should he lend to you unless you offer him something materially better? That is the real fight. A business trying to attract capital is not simply trying to look profitable. It is trying to look better than easy money. That is why the average person must understand bonds before he imagines he understands entrepreneurship. Entrepreneurship is not a separate universe floating above finance. A business owner is, at bottom, a capital allocator. He allocates money, time, labor, and attention. He commits resources now in the hope of a larger return. Later, the bond market is simply telling him what later must be worth relative to the safest alternative. That is the discipline. And once you accept that, the game becomes much clearer. Now, let me tell you how the richest people consistently beat bonds, not by working harder in the ordinary sense, not by becoming heroic micromanagers, not by staying up later than everybody else. They beat bonds by owning structures that can compound without requiring each incremental dollar of growth to consume another equal dollar of capital. That is the secret. The market likes to wrap this in glamorous language. But the idea is simple. Build once, sell forever. Software is the cleanest modern example. You spend the money on engineering, product design, and infrastructure once. Then the next customer does not cost nearly as much as the first. The marginal economics get better as the business grows. That is beautiful. If I sell one piece of software, then sell the same software to 100 or 1,000 or 1,000,000 people, my revenue can scale far faster than my cost. That is why capital-light businesses with strong moats are so valuable. The same principle can appear in less glamorous places too. A good brand is a system. A unique process is a system. A distribution network is a system. A knowledge product is a system. A franchise model done honestly and well is a system. The point is not technology for its own sake. The point is repeatability without proportional capital consumption. That is one of the great dividing lines in business. Some businesses must keep feeding the machine with capital just to grow. Others can grow while needing surprisingly little additional capital for each new dollar of earnings. Those are the businesses I love. Now, if you want to beat bonds over decades, I believe you need 4 things. Not one, all 4. First, durable moats. You need something that protects your economics from easy attack. A brand, a unique process, geography, trust, relationships, distribution, something that makes copying the business harder than outsiders. Imagine the source text correctly names durable moats as the first filter, Fay Falecite, Fay Turn 82, File 6 Fay, if risk-free money pays 5%. Then a business with no moat has a serious problem because a commodity business without protection will eventually get competed down. If the economics are easy to attack, the returns will not stay high long enough to justify the risk. Second, pricing power. This is one of the finest qualities in capitalism. If your costs go up and you cannot raise prices without losing the customer, then inflation and high rates will punish you harder than they punish a stronger business. But if you sell something truly needed, trusted, or difficult to replace, you can pass through higher costs and protect the compounding of the enterprise. The source material also names pricing power, and rightly so. Fay file a site Fay turn 82 file 6 Fay that matters more than many managers realize. A business with real pricing power behaves very differently in a high-rate world than a business constantly begging the customer for mercy. Third, low capital intensity. This one is the most neglected because it does not flatter people who love visible scale. Revenue is exciting, big facilities are exciting, massive projects are exciting, but if each dollar of growth requires another dollar of capital, then the business may never escape its own neediness. It may look large and still fail to compound wealth exceptionally for the owner. The source text calls out low capital intensity explicitly, and that is exactly where I would put a bright underlined Fay file a site Fay turn 82 file 6 Fay. I would rather own a smaller business with extraordinary returns on capital than a large business constantly eating cash to prove that it is growing. That is one reason I have always admired businesses that sell knowledge, systems, brands, services with embedded advantage, and other forms of light-footed value. They can grow without shoveling endless capital into the furnace. Fourth, disciplined capital allocation. You can have the right moat, good pricing power, and light capital needs, then still destroy value if management acts foolishly with the cash. This is where many otherwise good businesses go wrong. They make bad acquisitions, they chase vanity growth, they overbuild, they overhire, they mistake a temporary good cycle for permanent genius. They distribute cash poorly, they keep dead assets alive for emotional reasons, they borrow when they should not. All of those decisions matter. Outperforming the bond market for decades is not a matter of one clever year. It is a matter of taking each dollar generated by the business and deploying it rationally, repeatedly, and without vanity. The source document names disciplined capital allocation as the fourth filter, and it belongs there. Fay file site Fay turn 82 file 6 Fay. That is why I have always said capital allocation is one of the central management arts. The average manager thinks his job is to make the business look busy. The great manager understands that his job is to make every dollar productive. This is the whole game. Now, once you understand all of this, a lot of your life stops being mysterious. You understand why certain businesses die in high-rate environments while others strengthen. You understand why entire categories of consumer spending evaporate when bond yields rise. You understand why lenders grow selective. You understand why speculative stocks become harder to justify. You understand why capital-light businesses with moats and pricing power become more valuable, not less, when money gets expensive. And perhaps most importantly, you understand your own life differently. You stop asking, how can I make more money? You start asking, how can I deploy capital in a way that beats risk-free money by a wide enough margin to justify my effort and risk? That is a better question. It forces honesty. It also helps ordinary people who are not running 9-figure businesses because the same logic applies at a smaller scale. If you are building a side business, the question is not merely whether it can make a profit. The question is whether it deserves your capital and time relative to what safer alternatives offer. If you are choosing between holding cash, buying treasuries, buying an index fund, or funding an expansion in a small company, the bond lens forces you to compare, honestly. If you are considering taking on debt to grow something, the bond lens forces you to ask whether the spread remains attractive. If you are evaluating a job opportunity, a partnership, or a business line, the bond lens can help you understand whether the economics are merely flattering or truly compelling. This is why I tell people bonds are not a niche subject. They are the baseline subject. They are the price tag hanging from every financial decision in the economy. You may ignore them. They will still price your world. That is what makes them so important. And once you see that, you stop treating them as wallpaper. You start treating them as signal. When bond yields rise, money gets heavier. When bond yields fall, money gets lighter. When money gets heavier, wants suffer before needs. Projects needing financing slow. Weak capital structures crack. Speculation loses some of its charm. The honest business with value, moat, and flexibility endures. That is the cycle. No philosophy can wish it away. No politician can talk around it forever. No entrepreneur can escape it by enthusiasm alone. So if you want to be rich, really rich in the meaningful sense, learn to ask one boring question before you chase any deal: business, investment, or expansion. What am I being paid relative to risk-free money? If that question embarrasses the opportunity, walk away. If that question reveals a truly wide spread supported by durable economics, then perhaps you have found something worth your time. That is how you stop making emotional mistakes. That is how you stop getting drawn into bad deals merely because they look profitable. That is how you separate movement from compounding, and that is how you begin thinking like an owner instead of an excited spectator. The crowd wants headlines. I want the hurdle rate. The crowd wants narrative. I want the spread. The crowd wants action. I want economics. That is the difference. And if you hold on to that difference long enough, you may discover that the most boring number in finance was the one quietly deciding almost everything all along.